Now that we've reviewed the fundamentals of the credit scoring process, how to get rid of the bad stuff and put on good stuff, it's time to take a look at an average Joe buying a car and see how that affects his credit score. This will give you a little better insight into the credit scoring process in action, because it is a dynamic thing. The 5 different components that we've mentioned are all interlocked and work together in such a way that at first might be somewhat confusing, but begins to become more clear as we go along. So let's take Joe Average with his average credit score of 674 FICO and go through the car buying process and see just how this will affect his credit score and how his credit score will affect his car buying. One of the things that wakes us all up to having a good credit score is buying an automobile. Buying a house is a dream for a lot of people, but for a lot of people, buying a car is a realistic fact of life at most stages of their life. So it's time to take a look at just how the average person buying a car will have his credit score affect the buying process, and how the buying process will affect his credit score. Now, Joe Average has a FICO score of 674. This is his standard FICO score. There is actually 49 different models of FICO scores, believe it or not. That's for the advanced section of the course. Don't worry too much about that. But automobile FICO scores are judged a little bit different than your basic FICO score. If you have a good FICO score, I am sure you will have a good auto score as well. But the auto score weights different components a little bit differently. If you ever had a car that was repossessed, you're going to have a little bit of a problem with your auto score. If you are chronically late on your auto payments, that would have an effect on your auto score. But if you have been good with your the auto part of your credit in the past, you might have a little better auto score than you have for a general FICO score. I wouldn't give it too much worry, because you can't get it. Only the car dealer can get it. It's sold specially to them. It's not available to the public. But if you have a good FICO score, you're going to do just fine. So Joe Average decides he's going to buy a car. What will happen when he makes the application for the loan? Well, my first recommendation is that you go to your bank and make the application with your bank, or credit unions especially frequently have very good rates for cars. It's much easier to shop for a car, and a lot of people like to do it over the internet anyway today, if you have the money in hand. In other words, if your loan is pre-approved. If your loan is pre-approved, you are in the driver's seat when it comes to negotiating with a car dealer, be it at a dealership or a private person or over the internet. So rather than depending on the dealer's financing arm, I highly recommend you go to your own bank or credit union first and see what kind of a deal you can get from them. Once you're serious about it, they have to pull your credit score. So here's what happens. That is an inquiry. That is what is called a hard inquiry. Any application for a loan is a hard inquiry. Each hard inquiry costs about 5 points off your credit score for a year. So that's an unavoidable part of getting any loan. So the initial application for a loan for an automobile is going to be a slight dip in the score. There's going to be a couple of other things that are going to cause the score to dip in the beginning also. Besides the inquiry, the fact is that if you do get the loan, then the average age of your accounts is going to be lowered, because you have a brand new one to bring the average down. No way of getting around that, so you'll just have to live with that as well. That's another thing that will put a slight dip in your credit score along with the inquiry. The next consideration is the debt to available credit ratio that we've talked about. If you get a loan for $20,000 and you have $20,000 available credit and you owe the whole $20,000, you have a 100% debt to available credit ratio in the very beginning. Now, this doesn't hurt as much as it does with credit cards. It's judged somewhat differently, but still, as the payments are made on the loan, that will go down, and you will begin to get a more favorable debt to available credit ratio. So what happens when the loan application is made and when it's granted is these 3 things are going to cause a dip in the credit score. But the credit score will improve with time. That is the good news. The fact of the matter is that when you get the credit, the one thing that's really helpful, along with the negative aspects in it right away, is that you now have an installment loan. This helps your mix of credit, and it helps to counteract the negative effects of the lowered age and the debt to available credit, because you have an installment loan to go with your credit cards, and you have a better mix of credit, and as you pay it on time, you will be proving that you can handle an installment loan type of credit as well as other types of credit. So that is in your favor. Now, I mentioned that FICO has 49 different models. This is the auto enhanced model we're talking about in this example of Joe Average. You can call the dealer ahead about their financing arm if you'd like, but as I said, I would really consider going to your local bank or credit union first. Now, as far as interest rates are concerned, I'll give you a kind of a good example of how it works. Use a $10,000 figure. Of course, in this example, we would double these numbers. With an excellent FICO score of 720 to 850, at today's rates, you might pay about 3.8% for $10,000 is $295. And the next group of FICO scores, 690 to 719, that would be a very good, not excellent, but very good. The interest rate is going to jump to 5.27%. It's only a $6 increase in the monthly payment. Next drop down, and this is where our friend Joe Average is, the interest rate goes to 7.10%. The payment jumps to $311. Now, as you get lower than that, this is where you really get hurt. The next grouping from 620 to 659 goes from 7.1% to 11%, and the payment jumps to $328. After that, the payment, of course, it gets worse and worse. 16%, 590 to 619. Anything lower than that is really a subprime loan, and as such, really you can throw out the rule book on those. I mean, they give them out because, of course, they have security. It's not like just lending you money. They have security. They can repossess the car. But most of the people that make those kind of loans don't report reliably to the credit bureaus, so you lose the benefit of having an installment loan. You might want to ask them about that if you're in a difficult situation and you really have to go that route. Other than that, it is a terrible idea, but I understand that there are times when we have to make certain compromises in this world. Speaking of making compromises in this world, I would not ever co-sign a loan for someone that was in trouble about buying a car. It's a much better way of, if you're really in a mind of helping a family member or a friend, consider making a private loan without co-signing, because when you co-sign a loan, you are just as responsible as the person you're co-signing for. If you made a private loan to help them with a down payment, you may or may not get stuck with the money, just like you may or may not when you co-sign, but at least you'd be protecting your own credit score, and you wouldn't be getting dragged down through no fault of your own. So co-signing is never a good idea. And finally, pre-approval is the route to go, no question, that with pre-approval in hand, Joe Average has a much better chance of getting that dream car he wants for a very good price. A lot of people wonder why car insurance is tied up with the FICO score. The insurance companies will tell you that there's a direct correlation between FICO scores and accidents. A lot of studies have been done on this, and the correlation is kind of inescapable. And it seems that the claims are much higher with people that have lower FICO scores. Insurance companies feel that there probably is a better chance that that person needs money, or is desperate enough to hold out for more money, or is basically subscribes to the theory that people with lower FICO scores tend to be irresponsible people, which is anything but true. In my opinion, a FICO score has nothing really to do with a person's character. There are so many things that can influence it. It might be medical debt or job loss beyond the person's control. It's unfortunate that so many people do kind of think of it as a kind of a scorecard on a person's character. So, and the car insurance has its own credit score. It gives extra weight to such things as bankruptcies, and it can be as much as a 40% difference in insurance rates, depending on what your FICO score may or may not be, which is another thing about the FICO scoring system. As I told you before, is it fair? No, only in the sense that it treats everybody the same. So that concludes our look at Joe Average, and we will be moving along into more and more interesting areas in the 201 section as the chapters go on.